Hello my fellow freedom builders and welcome back to the channel. Today's video is about stop losses, how to use them, why we should use them, and it is a topic that I get asked a lot about. So I'll try to work my way through it today, telling you why you should use it, what kind of stop losses there are, how I determine where to set my stop loss, and I'll also talk something about why stop losses sometimes fail. It is a topic that there are a lot of opinions about out there. Some people love it, some people hate it. I can say that I'm a big fan, and I will tell you a bit more about it today. So, as I said, we'll talk about what is a stop loss, why use it, how to decide on a stop loss level, why not to use it sometimes, and how it can fail. So let's get right to it. First of all, if you like this channel, if you like this video, remember to press that like button down there and to subscribe to the channel if you haven't done it already. So, what is a stop loss and why should we use it? Well, let's jump right into my charting package here, TradingView. That is my favorite charting tool. And here we have a Danish stock. Not many people outside Denmark know it, I think, but it's called Cbrain. It doesn't matter because this is in principle and it goes for all stocks. So what is a stop loss? Well, this is a stock that I bought the other day. I bought it here around 78, I think it was. And what I do when I buy a stock is that I say to my broker, I want this stock and I want it right here. Could be by a market order or a limit order, but then I do something else. I also say to my broker, if this trade goes against me, and it could be for all different reasons that I'll get onto in this video, but let's say that down here in 63, if the price gets down here, the trade has not developed the way I thought it would, and therefore I want to get rid of it. Therefore, I put in a stop loss order, and a stop loss order is actually just you putting into the system a sell order if a certain price is hit. And it is the same as with the target up here. That's also a limit order where you're telling if it goes up here, I want to sell it, I want to take my profit. But down here, it is a stop loss order if it is a long buy of the stock. And that's as simple as that. It's just a number in there, and when the price goes up, as it has done in this case, you can move your stop loss. I'll get back to that as well. Sometimes, and with some brokers, you can put in what is called a trailing stop loss. That is a stop loss that automatically moves upwards. But let's get back to that later. So a stop loss, and that is important that you remember that, because that we'll get back to that when we're talking about why stop losses sometimes fails. So a stop loss is not something magical. It's not something that guarantees you that you get out of a stock. It is simply a sell order to your broker. So why should we use stop losses? Well, there are several reasons. Let's look at Cbrain here. It had a good run here last year in 2019. I was in on some of it. A stop loss can be used to make sure that you limit your risk. Meaning that if, for instance, you get in, let's just say that you get in right here into Cbrain here. Now, this one went well, but if it had turned against you and you don't have any clue as to where you want to get out, then you can be in for some really tough damage on your account. Now, it could of course also have been that you bought it right here, and then you would, if you didn't have a stop loss, you could be down, worst case, 55%. You could of course have held it through all the downturn here, and you could be sitting now at only around 20%. But a stop loss is something that makes sure that you get out of your losses quickly. Of course, there are some disadvantages to it as well, because let's say, for instance, I had bought the stock here, and I got sold out via the stop loss here, and then the price went to the moon here, and I didn't get in again. Then, of course, that would be a disadvantage. So sometimes you are getting kicked out of a trade that just turns around right after and goes straight to the moon. But there's nothing that forbids you to enter a trade again when the stop loss has been hit. But a stop loss is just there to make sure you're not taking too big of a hit. Another thing here is that when you have a stop loss, it is a lot easier to control the risk you're taking on each and every trade. So for instance, let's say that I'm buying right here again. Let's just put in the line. Let's say it is right here. I'm buying at a price of around 62. Now, if I have my stop loss and I put it, let's just say for the fun of it, down here, I'm getting in at 62 and I'm getting out at, let's just say 47. That is 15 points down. Now, then it is easy for me to calculate how much of this stock I can buy. I have made another video about it, but what I do is that, let's just say that I have 150,000 units on my account. Could be kroner or dollars or euro or whatever. I have 150,000 and I can risk 1% of my capital on each and every trade. That is 1,500 units. Now, when I know that I enter my trade here and I have my stop loss 15 points away, well, then I just divide the 1,500 I can risk. I divide that with my stop loss, and that is 15 kroner in this case, meaning that I can buy 100 stocks. Then I know that when I buy 100 stocks, if my stop loss is hit, I have only risked 1% of my entire capital. That's how it is, and that is one of the reasons why I really love the entire concept of stop loss. It also makes it easier to calculate your reward to risk. So if, for instance, you have here, let's just bring it down here. Let's just say that you enter at this price level, you have a stop loss here, and you have some sort of target. Let's say that you are having a what is called a 3R target. Then you can tell your broker, I want to get out of this trade if it hits 3 times my initial risk. So if I risk 15 units, then you know that you can get out at 45 units in profit, and that makes it a lot easier to back test and to put your trades into a trading journal and keep some track on the stats. So there are a lot of reasons why I like the stop loss. Of course, there are disadvantages as well, but I think it is important to have some sort of idea. I know some of you out there are using more a fundamental approach where you are entering a trade, for instance, on some earnings numbers or earnings per share or price earnings or PEG ratio or whatever you're using as the trigger for entering. Even there, I would suggest that you take a look at the chart and you get some sort of feeling as to when should I get out of this, because I've seen way too many fundamental investors buying a stock out of some fundamental criteria and then holding it from 100 to 1 simply because they didn't have some sort of exit criteria. So it is important. Now, what kind of stop losses are there? How do we decide on it? Well, I have 3 of the most common here. I have what is called a percentage stop, something called a volatility stop, and then a chart stop. And what I use personally is a combination between the volatility stop and the chart stop. But let's just say the percentage stop is something that some people, if for instance they buy here at 75, let's say that, then they take a fixed percentage. Let's say it is 10%, and you're saying I'm buying at 75 here. Then they are putting their stop loss at 10% right here. And that's just a fixed number, or it could be 8% or 12% or 20%, but it is a fixed number. And I'll get back to in a second why that is not the smart way to do it. But that is the percentage stop. That is just to see where did I enter, and then they are pulling down 10% or 20% or wherever they wanted the stop to be. But what I like more is the volatility stop, and that is a bit more of a complex way of calculating it. But luckily today we are having computers that can calculate it in a second. But let me just show you a picture here. Here we have two different stocks. It doesn't matter what the stocks are, but try to look at the structure of these stocks. One of the stocks is going up almost in a straight line. So the daily fluctuations here are not very large. Very small increments it is going up and down with, but it is going more up than is going down. Now, if we are taking a look at this one, that could also be a good buying candidate. I don't know. But take a look at how this one is going here. It is a lot more volatile. And that means that if you were to buy this stock here and this stock here, and you would be taking the same percentage stop, that means that it might be fine for this one, because it might be that the percentage stop would be here. But in this stock that is going up and down a lot more, you would be likely to be stopped out very quickly. Let's say your stop was 5% down. That would not be hit here, but it would quickly be hit here because the stock is jumping up and down. And that is why we need a volatility stop, where we're looking at how volatile is this stock and how volatile are the movements in the stock. And then we adjust the size of the stop loss according to how volatile the stock is. So let's have a look at it. The indicator we are going to use is called ATR, or Average True Range, and that is included in, I think, pretty much all standard trading packages today, no matter what platform you're using. I'm pretty sure there's some sort of ATR, or Average True Range. But what ATR means is it is a calculation where you can see here it is taking the largest sum it can find between previous day's close and today's high, or previous day's close and today's low, or the current high, the difference between the current high and the current low. So it has three different scenarios, and it is picking the largest one of these three distances. So what it actually does is that it is trying to figure out what are the max movement from day to day. That is what is called the true range. Now, an average true range is pretty much just if it is figuring out that in one day there are 10-point movement, and the next day is 15-point movements, and then there are 5 in true range and 7 and 20, and then average true range is just taking the average of all these measurements here. So let's try and have a look at it in a real chart here. We can have a look at it in Cbrain if we want to here. I just put the average true range indicator in down here, and in TradingView you just push this indicator in strategies, and if you can't find it, you're just typing in ATR, and it tells you average true range, and you can just push this one and it is applied to your screen here. So what we see here is that we have average true range of 14 periods. So now we are on a daily chart, so of course it is taking 14 days back, but if it was a weekly chart it would look 14 weeks back. So right now, if we should take a stop loss here and find a good level, and let's say I entered here, let's just say in round numbers at 80. I don't remember exactly the price I entered, but it was around 80. The day I entered was the 7th of April. So let's look down here and see what the ATR was at that day. That was just around 6 kroner, 6 units for that day. And of course it is kroner because it is a Danish stock, so it is in Danish kroner. So what we can do now is that depending on how much room we want to give the stock we buy, we would probably not just give it one ATR of stop. That means that we would buy it at 80 here, and we would have a stop loss 6 kroner, 6 units down from here. That would only be down in 74 around here. That would probably not be enough. So normally you take 2 or 3 times the ATR, meaning that when the ATR is 6 kroner, and that of course means that the average range from day to day here over the last 14 days has been 6 kroner. So you would take 2, maybe 3 times that. It is important that you take the same number every time if you want to have your approach to be systematic and rules based. But let's just say that it was 2 times ATR. That would give you 2 times 6, that is 12. And you would move that down to 68 down here. What I do is then, because I mentioned something called the let's just find it here, the chart stop as well. So what I do down here is that I just take a look and see if there are any obvious places where you can put your stop loss. Now this is on a daily chart, and I actually normally look at a weekly chart, so my stops are a bit farther away, but the principles are exactly the same. If you're looking at a daily chart, weekly chart, monthly chart, or if you're a day trader looking at a 5-minute chart, the principle is the same. So here we can see that the stop is 12 points away, and if I had 100,000 units in my account and I could risk 1%, that would be 1,000 units. I would just divide that with 12, and then I would know exactly how many stocks I could buy. Then of course a trailing stop is where you are moving your stop up. I'm normally not using the automatic trailing stop with my broker. I'm just using it by myself. So I'm tracking my stocks on a daily basis. So the first day data went up, and at one point it was up here around 86. I went down and looked and said, well, I'm about 6 still, maybe 5.5. So 2 times that would be 11 points away. So we are at 86 minus 11, that is 75. Then I could move my stop up to 75. When today is gone, let's say we are closing here at 91. It is a very good gain, and the average true range is around 5.5. That would be 11 again. So I could move my stop up to 80, and now I would be at a break even. So, but what I am, and you know that if you've been following my videos for a while, I am a trend follower. So it is tempting just to say, I want to close this trade now. It has given me a nice profit. But the core principle in trend following is to cut your losses and let your profits run. So I don't have a clue if this stock will turn right down and hit my stop loss, or if it will continue up 500%. Anyone that tells you that they know exactly what stocks will go up 500% and which stocks won't, they are simply lying. Nobody can predict that. So what I'm doing is purely a numbers game. I have a strategy, and you can see that in the playlist called Learn My Strategy. I have my strategy, and I know it is profitable over a very large number of years where I've been using it, so I stick to my rules. Meaning that maybe out of 50 investments or trades over a year, 3 of them are going up with 300%. And then the rest is break even. But from these few trades that goes up a lot of hundreds of percent, that is where I make my living through the year. So you should never try to outguess which stock is going up and which is not. You should just have your rules based, at least if you're a trend follower, and then just follow it up, moving your stop up. Let's say in a couple of weeks it is in 120. Well, then I can move my stop up and I have locked in a profit. If, of course, I'm not unlucky, as we'll see in a second, where there are some times that stop losses fail. But just remember, you need to base your stop losses on a volatility factor, or at least that is my opinion, that is the best. And I use the ATR. There's another one called ADR, average daily range, I think it is, and there's might be one more, I'm not sure. But I use the ATR. It doesn't really matter which one, just it needs to be an indicator that shows you how volatile is this stock. And you can make the time span shorter. You can make it 7 days to get a bit more of a feel of the recent days here. If you are trading on a shorter time scale, that doesn't really matter. So that is the part on how to set it. Then of course there are some ways it can fail. Why not to use it and how it can fail? Well, if you're taking a look at Cbrain again here, let's say, for instance, that, let's just have a look at it here. Let's say here that I am in this stock and I have been in it for a while, and I have put my stop, let's just say right here, just for the case of it. And that is at 65.5. Let's delete some of the other stuff here. All right, so I can see that it's getting close to my stop loss, but the stop loss is not hit yet. But I know, or at least I thought I knew, that I would get stopped out here at 65.5 right now. This day it is at around 68. So I know there's not far down to my stop loss. I am pretty sure when I go to bed this night at the 11th of March that my stop is pretty in safe hands here at my broker. But what happens is that the stock gaps down. And that can happen for a million different reasons. Maybe some new numbers come out. If it is a pharma healthcare company, maybe they are getting we thought they were getting an FDA phase 3 approval, but they didn't. Or so we see stocks gapping down 10 or 20 or 30% all of a sudden. And where you thought you were getting out at 65.5, you were getting out at 61 instead. Of course, that might not be the biggest catastrophe in the world, but it is. It means that you have been taking a larger risk than you thought. Now, why didn't you get out here at 65.5? Didn't you make an agreement with your broker that he should sell you out here? Yes, but just remember that what we have done is that we have placed a normal sell order if a certain level was hit. And the broker, as soon as this level is hit or it goes through it, the broker starts to see if they can find a buyer to your sell order. But it is a buy and sell system, so there need to be a buyer. There are a few brokers that have introduced something called a guaranteed stop loss. And that means that if there are no buyer to your sell order, then the broker will buy the stock. But they are charging you quite heavily for that, of course, because they're taking a lot of risk on their book. So I would not recommend using that. That can be a bit expensive in the long run. So what actually happens here is that the broker tries to, when the market opens, it opens down here, and the broker says, "Oh, wow, we had a sell order up here. Let's try to get that one sold as quickly as possible." And then they are filling you to the best possible price. And that might be here at the open at 60.9, but it might also be further down, maybe at 58. So when you get to your computer and you can see that the stock is gapped down, you can see that you have taken a significantly larger loss than you thought you would. And that is, you could say, the downside with stop losses. At least it's a factor you need to think of. Maybe with single stocks, and if you have 10 or 20 stocks or something like that, this could be a minor, maybe you're getting sold out 3% larger, 3% further down, but you only have maybe 5% of your portfolio on this one stock, so it's not really a big hit. But if, for instance, you're day trading and you are trading in Forex, some leveraged positions, then a gap down can be really, really expensive. Let's say I have been in a position here in some sort of instruments where I had leveraged 10 or 20 times a very large portion of my portfolio here, then a 3 or 4 or 5 or 10% gap down can really, really be expensive. So you need to know, and I've seen that several times here in the last month or so, where the market has been really crazy and oil has jumped and stocks have jumped. I've seen some really angry people on Facebook saying that my broker is no good and I had a stop loss at 100 and I got out at 80, and what are they thinking of? Well, they just have a system where they're trying to sell your position, and if there's no buyer to that position, well, then you can be in trouble, even though you have a stop loss. But in my opinion, the vast majority of times it is great to have a stop loss, and they are getting filled pretty quickly around your stop loss. Especially when I am trading out of a weekly chart, then my stop losses are far down, and it is very, very rare to see that my stop losses are getting overrun by some gap. It should really be a dramatic gap then. So that's about it. That's the stop losses, and we got through the, let's just see here. Where is it? What is a stop loss? Why use it? I have talked about that, how to decide on the stop loss level. I usually use a volatility stop combined with a chart stop, where I'm looking at where is the last bottom, and I'm trying to adjust my stop so it is somewhere around the last bottom in the chart. Why not to use it, and how it can fail? Well, it can fail if the price gaps down and some surprise comes out in the market. But normally it is fairly safe, and if you are investing and trading in the larger stocks, the S&P 500 or the large and mid-cap stocks in any given country, then you are pretty safe, because there will be buyers at most levels. It is more when you're getting down at the micro cap, at really illiquid stocks, where maybe they are only trading 5 or 10,000 stocks per day, then all of a sudden you can see that your stop is simply overrun. So that's about it. If you want to see how I use the stop loss combined with risk, I have a video about that, and I will link to that below the video. The platform I have used here is of course TradingView. I'll also link to that below. And if you haven't done so already, please hit the subscribe button, the like button, all the buttons you can find down there. And I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.